Well, for more on the Asian financial crisis and its legacy, we're joined by Dan McClory from Irvine, California. He's the head of China for Bousted Securities. Welcome back, Dan.
Thanks, Rachelle. Always great to be on your show.
Now, Dan, what would you say are the biggest takeaways from the financial crisis?
Well, there's several, and probably the first one is, don't borrow in dollar-denominated debt unless you understand the implications of what happens when exchange rates change. So that's a real big one. We heard from Andy, who joined from Kuala Lumpur. He was telling us his own personal example right there. That's a really important point. The second one is, don't run current account deficits. I mean, that's just in general bad. The third one that I think is extremely important, and this is, allow exchange rates to fluctuate. The government stepping in and intervening time after time. There's, in some cases of these countries that ran into crisis, there's just not enough money to put against the problem. So you've got to let those rates fluctuate. And as we heard from Indonesia, the banking center intervention is extremely important. You've got to have good banking practices. You've got to restructure through the banks. And one of the things that you alluded to in the open, Rachelle, had to do with the World Bank intervention and how that was blamed for really magnifying the problem. And I'd have to agree with some of that. The austerity measures that they imposed and allowing banks to fail, unlike with the U.S. during the global financial crisis, was clearly not the way to go.
Now, in terms of how countries were affected, obviously some bore the brunt more than others. So which countries were most affected and why?
Well, Thailand for sure. Of course, they were the domino that set everything off. And that they were really left in a world of hurt for quite a long time. And same thing that Andy told us about, and that was there was too much dollar-denominated borrowing because of the interest rate arbitrage. It made it look attractive or temporarily attractive. And then when exchange rates moved because the dollar was yielding greater returns because the Fed had increased interest rates, it put things into just a calamitous turn. Now, Thailand and some of the other economies in Southeast Asia, thankfully, have come out fighting with a strong consumer sector. So they're not as dependent necessarily on foreign direct investment and exports. They're important, but they've got a thriving consumer sector now. So that was really important. But I'd have to say Thailand was right up there. And we heard about Malaysia. Malaysia had a lot of difficulty, and they attempted to work their own way out of it. But those are probably two of the more difficult examples.
And speaking of Malaysia, we did see that some countries took different approaches. Some, as you mentioned, took matters into their own hands. Others turned to the IMF. Some tried to stem capital outflow. Some really tried with tough reforms. Which countries rebounded the best, and what did they do right?
Well, the countries who rebounded, clearly you would look at Korea. You'd say that that's an example of a country that has come back and was somewhat on the brink. Indonesia as well. And I would say Malaysia, the jury is really still out. I mean, a vibrant consumer economy. However, some of the measures that they took weren't necessarily the correct ones. But if we want to look at what has made the comebacks of the countries successful, it has been getting any current account deficits under control. It's been holding foreign exchange reserves that are primarily dollar denominated in excess of their domestic dollar-denominated debt. So in case there's a run on the bank, they're able to cover. And also those countries that have a more balanced and diversified approach to the holdings in their stock markets.
Right.
And again, I look at Malaysia and I say they've got a lot of foreign influence in that stock market. There's only 15 to 20% of domestic money in the Malaysian stock market. If for some reason capital becomes more attractive with greater returns outside of Malaysia, there could be a crisis on that stock exchange.
Now, Dan, with more and more free trade and interconnected economies, a lot of people are wondering, is fear and panic more easily spread now? And could that potentially be an argument against more globalization?
That's a great point, Rachelle. It really, really is. Because the ability for markets to react in real time, there is no more stagger, no more delay, arbitrage. I mean, markets react in real time, and there is panic, and there are rushes for the exits, as they like to say. But I think what has occurred since 1997, and China has clearly been at the forefront of a lot of this activity, is to put together more regional trade blocs instead of completely global trade blocs. So to have entities that might share common challenges, might have very similar and common economies, to band them together instead of trying to be this global citizen that's connected with, the four corners of the world. I think that's been a major, major advancement. You look at things like the Asian Infrastructure Development Bank, good move. Let's put together regional alliances and let's have countries come together in their sphere of influence of the world where they can help resolve issues, where they can help each other out.
Well, certainly lots of lessons learned. Thank you so much for your insights. Dan McClory, head of China for Bousted Securities.